everyone, welcome to another Wisdom Update. I thought this week I'd talk a little bit more about what the Reserve Bank cash rate actually is. How does it impact the economy and as a result of that, interest rates? Why does that matter? And there was a really interesting article that came out this week, which I thought was worth discussing more about what a neutral rate was for the Australian economy and what that meant for us and probably what that meant for the future. Now, I've already spoken at length about the fact that we saw the first rate reduction of 0.25% to the Reserve Bank cash rate last week. Now, of course, as mortgage holders, as people that are paying big interest rates, that comes as great news to us. But I think what often gets missed is, well, how does a Reserve Bank cash rate actually implicate the economy and why does it set the interest rates? Essentially, the cash rate is pretty much the singular most big lever that the Reserve Bank can pull with regard to setting interest rates in the economy. And as a result of that, how much investment occurs and how much money, gets invested in the economy in general. If you think about it in these simple terms, basically, when the interest rates are low and money is cheap, people are more inclined to borrow money or borrow more money. And as a result, they either spend that on things or invest that in things like businesses, property, and other things as well. Conversely, when the interest rates are high and money is expensive, people are less likely to borrow more money. They're more likely to pay back money, including sell things. And so the implication that has for the economy in general is that when the Reserve Bank sets the cash rate as lower, well, then people will borrow more. That will effectively be expansionary or increase the economy and push demand and other things forward. So in other words, it has a tendency to grow the economy overall. Again, conversely, when money's expensive and the Reserve Bank sets the cash rate higher, as a result of that money that we are borrowing is more expensive, that has a contractionary effect on the economy overall. And so that's why the Reserve Bank cash rate is quite important. If you think about it, whenever they set it high, it contracts the economy. Whenever they set it low, it expands the economy. Now, why having a high interest rate at this point in time as well has been really important recently is because the other thing about expanding economies is they have a tendency to be inflationary. In other words, there is much more demand for things. There is much more fighting over the available resources, which has a tendency to push price higher and cause inflation overall. And so why the Reserve Bank at the moment is obviously keeping the interest rates high in the economy is because they are trying to bring down inflation, and we certainly know that. Now, the other thing is they've got to be careful about reducing it too quickly because, as we say, as the interest rate decreases, the likely impact on that is that the economy will continue to expand or expand more than it currently is. So there's a concept of what's called a neutral cash rate, and effectively there's quite a complicated calculation to go into this, but the neutral cash rate is at what rate does the Reserve Bank set the cash rate such that it is neither expansionary or contractionary in nature. So in other words, what is that neutral point where the Reserve Bank cash rate is not having an implication on the economy to either grow it or to contract it? Now, historically, that rate has been 3.5% on the basis of the calculation as to how the Reserve Bank does it. And that is obviously, monitored and checked and changed over time, but 3.5% was a pretty good indication of the last calculation on the basis of the last 10 years. So in other words, if the Reserve Bank had the interest rate at 3.5%, it would be neither expansionary in nature, nor would it be contractionary. So what they've done is they've looked at other large economies, particularly Western economies right around the world, and they've looked at the way that their central banks calculate that neutral rate, and they've tweaked the calculation. Now, they did sort of talk about this, but they didn't actually say what implication it had for the calculation of neutral rate. Now, interestingly, Commonwealth Bank have obviously taken this change in calculation. They've done the math. They've looked historically at all of the results and what it would mean for Australia if that calculation was changed. And the figure that they've come up with is actually 2.9%, which is lower than the 3.5% that the Reserve Bank has historically used. Now, what does all of that mean? And what does that actually mean for, all of us that are paying interest rates and everything else? Well, what it means is that when the interest rate settles down over time, so when we effectively complete this cycle of having high interest rates and then reductions back to a neutral rate, it is actually likely that that neutral rate will be lower than what everyone's talking about at this point in time. Right now, it's set at 3.5%. Commonwealth Bank and others, based on the new calculation, actually feel that it will be closer to 2.9 or 3%. So this is good news, again, particularly for us that, pay interest rates on all of our investment. What it means is that when we eventually finish this cycle, it is actually likely that the interest rates will be quite low at the end of this cycle, and certainly lower than what everyone originally expected, which was it would settle out at about that 3.5%. So I think that's great news, and I think it's really interesting and something worth talking about. It's something to get excited about. The other thing that I think feeds from that is that the fact that the Reserve Bank are being very, very careful about all of their messaging, so all of the words that they're saying, all of the things that they're talking about. They gave us this interest rate reduction. They said, look, that's it, guys. We're not going to see any more. Look, I want you to make sure that you are seeing through that nonsense. The reality is the Reserve Bank has to do that to make sure they keep everyone's expectations really low, that they keep the market's expectations really low. They don't want people running around and spending a bunch of money expecting there's going to be, big interest rate reductions in the future. So their messaging is going to look like that the whole way through. The reality is they're going to be saying things like, no, there won't be a reduction, there won't be a reduction, there won't be a reduction. And then, of course, 5 minutes later, we'll see that they have a meeting and there will be a reduction. So what's probably more important in that is listen less as to what the Reserve Bank is actually saying. Watch what the markets are doing and pricing in. They're looking at the economy. They're running the same numbers that the Reserve Bank is as well. And they're being a bit more realistic and a bit more open about the fact that actually, we are going to see further rate reductions. It is still an expectation that we will see potentially up to a further 3 reductions over the course of the remainder of 2025. Which again is a good thing because we will pay less on all of our mortgages. But in a way, it's a bad thing as well because it means the underlying economy is not going all of that great. And so, look, I think we could look forward to some further rate reductions. I myself, with a lot of debt, am certainly looking forward to that. And I'm keeping my fingers crossed for all of you out there as well. So look, hopefully you found that interesting. I certainly did. And I thought it was really worthwhile to talk about with regard to what we might see in the future. So until next time, thanks for watching. Happy investing and bye.